Hello and welcome to Real Estate Today. My name is Ed Cox and my co-host is Maria Babicki, and we have an interesting show for you today. We have a great guest that we'll be asking a bunch of questions to. So Maria, could you introduce our special guest and get the show started?
Sure. Our guest today is Dan Rosenfeld, Vice President and Sales Manager of Leader Bank. Welcome to our show.
Thank you very much.
Thank you for coming today. Why don't we start off with how long have you been in the business?
Been in business 30 years.
Okay.
And I work for Leader Bank.
Okay, can you tell us a little bit about
Sure.
Leader?
Leader Bank is a privately owned bank based out of Boston. And there's about 140 some odd banks in the state of Massachusetts, and we're rated #1 among the banks for mortgage lending.
Oh, great.
It's really the thrust of what we do.
And you're right here in Simsbury.
And my office has been right here in Simsbury for about 5.5 years now.
You could walk here.
Yeah, I'm located right above McLatten's. Yep, on the second floor.
Right.
Okay,
Yep.
couldn't be more convenient.
Very convenient, yep.
So what's going on right now with mortgages? What are you seeing?
Well, it's kind of an interesting thing. So the first-time buyer market is alive and well, as you probably know. About 34% of all homes being purchased right now are first-time buyers or millennials. The money is plentiful. There's zero money down, 3% down, 3.5%, 5% down programs are plentiful. And right now we're seeing a big increase in that because the cost to rent has gone up dramatically. And now home ownership has actually become even more affordable than renting.
Okay.
So are there some favorite loans that are popular right now?
I wouldn't say favorite per se, but we're not seeing large down payments like we used to in years past. I would say probably 30 to 40% of all loans today have gifts associated with it from family members and relatives. But 5 and 10% down loans are very, very common these days.
And the gift could even be involved in a 5 or 10% down one?
Absolutely, yeah. It's an acceptable source of down payment. Yeah.
Okay. And we had a client who was selling their home and they had an FHA loan, and or someone made an offer with an FHA and she had heard that they were a bad loan.
Yeah, that's really kind of an old wives' tale. That's a misnomer. FHA loans are excellent loans. They're government backed. The thing with FHA loans is the house really has to pass the smell test, as we say. It can't have chipped or peeling paint. Has to have railings on staircases and decks and things like that. It can't have a huge tree limb hanging over the house or, missing tiles on the roof. It has to do with habitability. They want to make sure the house is habitable and there's no health risks associated with or health hazards.
And if, right now we were talking about just before the show, if someone were thinking about buying a house in the future, my recommendation always is to contact someone in the lending field. And would you recommend that they talk to you first?
Yeah, I'm really phase zero, as they say, right in the beginning, to really find out what your comfort level is, what your affordability is, what your credit looks like. Every single day I get a phone call that says, I got a credit card and my credit score is 700. Well, yes and no. Because the platform they use in the analysis for credit reports for credit cards or car loans or miscellaneous kind of credit is not the same as a mortgage. It's a really different formula that we use. So a mortgage credit score is typically going to be a little bit different and lower than if you were just getting a snapshot for a credit card. So ground zero is really, basically starting to see what's on your credit report. Make sure there's no surprises.
Right.
Make sure that, and also what you're comfortable paying every month.
In this credit rating, if just by chance they did find some surprises,
you can get them rectified
before you actually get out there and start buying and be surprised.
Yeah, I would say the average time frame to get something repaired or fixed on your credit report is probably 8 weeks. It could be a little sooner, it could be a little later than that. So you really want to do upfront. And I've done that for clients where they've had things that had to be repaired and fixed on their credit. And it did take time, but it eventually got handled.
Okay. And what's a typical turnaround for a mortgage these days?
Mortgage approvals, depending on where you go. If you walked into a bank, they're going to tell you 30 to 45 days to get approved. We're quicker than that. I can close somebody start to finish in 30 days. But typically it's about 30 to 45 days if you just happen to walk into a bank to get approved.
And since I've been in the real estate business, we always say that interest rates are going up, and I've said that because I've hear that they are. How are interest rates right now?
Actually, interest rates are very stable, and actually in the last few weeks they've come down. So it's really still a great time. If you look historically where rates have been and where they are right now, rates are actually close to historical lows.
So you can close early and have good low interest rates.
Yep.
That seems like a good
so
time.
it's a great formula, and that's why owning may even be cheaper than renting potentially. Exactly.
What is the biggest challenge of your job?
My biggest challenge?
Yeah.
I would say the biggest challenge is unrealistic expectations, potentially.
Okay.
I think, because really the home inspection is the first thing you do once you sign the contract, and working through home inspections, and that I'm finding is taking quite a bit. Because, what is it, a week to 10 days to get the home inspection report back, and then once you get it back, you negotiate potential items to see if they're, deal breakers and how serious they are. So I think the expectation, is once everything's negotiated, how fast can we get approved and how fast can we close?
Yeah.
I think everyone's not really used to the amount of paperwork. So what people say to me is, well, is it hard to get a mortgage today? It's really not hard. It's just that the paperwork is a little intense. Ever since the mortgage meltdown of 2008, no one's going to take your word for anything anymore. So if you're getting a gift from a family member, which is allowed, or if you're taking a loan against a 401k, or maybe you're selling something to come up with money, everything has to be documented. So you remember that movie where they said, "Show me the money"? Well, it's show me the money. It's you've got a paper trail and document everything, where the money's coming from to do the transaction.
Okay. I had a younger couple approach me, and they are interested probably in buying a home, maybe in the next year or so.
Yeah.
So how soon, should they come see you now to plan for a year from now, or what should they
I
be
would
doing?
say 6 months before.
Okay.
I mean, they could come now, it's fine.
Yeah.
But at least 6 months, 6 to 9 months before, you really want to start lining up your ducks
Okay.
to make sure.
And what about length of employment? If somebody just started a new job, or does that have an effect?
That's a great question. If somebody had just graduated school, we don't require any employment history whatsoever. Show a copy of the diploma or the transcript, new job, out of school, you're good to go. There's no 2-year history needed. But theoretically, you're supposed to have a 2-year work history. If you were a stay-at-home, provider, if you will, and then decide to get back into the job force, we're looking for at least 6 months on the job for at least 6 months before we can really count the income.
Now, what are you saying with people who are looking for something like a 55 and older community? What do they need from you? What are they asking for?
It's very interesting, because I've done quite a bit of loans for people who are 55 and over and potentially selling their single-family home in town and looking to buy a condo, whether it's 55 and over, or maybe a smaller house. And that requires definitely some legwork up front, because the question then comes down to is, what are we using for income? And if they're still employed, then obviously it's a no-brainer. But if they're not employed anymore, then what are we using for income? Are we only using Social Security and pension? And if so, is that going to be enough to carry? But it may not be. So then we get into basically finding out about their assets and really kind of using their assets to derive some income from retirement accounts and doing structured disbursements on a monthly basis. And that can be used as income. And I've done quite a bit of that. But that really requires a conversation and a meeting way before they list their house for sale. And typically on those, you're typically purchasing the 55 and over smaller home condo before you sell your house.
Right.
Because you really find those clients really want to buy first, get settled, and then sell their house.
So is that also like the younger buyer, 6 months in advance or so, or how much time would you need?
Yeah, I would say 4 to 6 months in advance. Okay. Have a conversation, see where your comfort level is, how much you need to save, or how much of a gift. A lot of times the younger couples, I'll say, oh, you've been on your job for X amount of years, you have a 401k, can you borrow against your 401k for down payment? Not withdraw it and pay penalties, but can you borrow? So I immediately tell them to contact the administrator of their 401k, whether it's Fidelity, Vanguard, Hewitt, or whoever's doing it for their company, and find out what are the options. What's the loan, for how long, how much you're going to take out of your paycheck, things like that. Yep.
And I think we talked about it at lunch the other day, was somebody here who lives here in Simsbury, but now thinking about buying in Florida, say.
Yep.
Would they still be able to talk to you?
Absolutely. Yeah, we're a federally chartered bank, and we have the ability to lend in a lot of states, most states. As a matter of fact, I think 20% of the loans I did over the past summer, last year, 20% were out of Connecticut. I mean, Arizona, Florida, Tennessee, Nashville, I mean, all over. Because like you said, people in Connecticut sometimes do relocate.
And some of your long-term clients, being that you've been in the business so long.
Right, right,
Right. So
yeah.
I do know I had a conversation, we were at dinner, and a couple my age were thinking about kind of selling their house to one of their kids.
Yep, I have one right now like that. Yep.
And what is there? I don't know. How would that work? How would you think that should work?
Well, in a fantastic or perfect world, the parents can gift the children some of the equity in the house. So the children have built-in equity, so if they're only putting minimal amount down, they won't have any mortgage insurance. So it really will come down to the appraised value. Also, what are the parents looking to get out of the house? So let's say it's a $300,000 house, and the parents really only want $200,000. That's what they want for, So, do you write it up for, the $300,000 or $275,000, and the difference is the gift of equity. So the appraisal really drives the bus on that. Yeah, but we do quite a bit of that.
Okay. And then they would do that and then buy whatever it is that they're buying.
Right.
Once they got that in place.
Yeah, I got a call the other day from a woman who was one of 5 kids, was left the parents' house. The parents had passed. She was part of the estate, and she wants to buy the home from the siblings. So how do we structure that? And the advice basically is the her 4 siblings, basically sell her the property. And then she basically waives her right to her 1/5, of it.
And that's her down payment.
And that's, yeah, exactly. Yep, figuring that out, yep.
And I think we were talking about just even, and what is there things out in inspections these days that are causing some ruckus in lending world? Foundations,
Yeah, I would say that's probably because now there's a disclosure, I believe, in your real estate world where they have to sign something about concrete foundation, and sometimes if there's a hairline, tiny crack, you might get a little more concerned than you did years ago. Whatnot. Are you seeing a lot of it in Simsbury?
We are not.
No, we're not.
We
I
are
think
not.
so.
We are not.
Other parts of Hartford County or
Yeah.
Wyndham or Tolland, yeah.
Maria and I had I had two listings, and between the two of us,
Yeah.
we had several. All our properties were really built before the real
Yeah.
foundation issues, but it does seem to be a big concern
Yeah.
East of the river.
Right. What about septic? Are you seeing septic issues? Or not necessarily, even more so now?
No, but I know that word is out that some of the cement in the septic tanks could be coming from the same source. We most certainly, especially I think in Simsbury, is that there's a lot of properties that are built in the 50s, and septic tanks built of cement last just so long.
Right.
So I think septic tanks are becoming more popular these days as the thing that's good is that you can replace a tank without having to do all the rest.
I was going to say, in the scheme of things, the tank replacement's not a big deal.
Right.
Right.
Only as if it's a $120,000 house, and if it's a $700,000 house, you just figure it out. It's easy.
Yeah, exactly. Yep.
How often do you come across people who put in a cash offer, but behind the scenes they're working on a mortgage?
I would say 50% of the time.
Yeah.
But the person who puts a cash offer absolutely must put in the contract that they have the right to get an appraisal done.
Yeah.
Because if you really think about it, if they're paying cash and they're not disclosing they're getting a mortgage, why would an appraiser be calling somebody to get access to the property? So they have to put in the contract they have a right to get an appraisal done of the property. And that way my appraiser can get into the property. With cash offers, the seller typically wants, and the listing agent, proof of funds. So they want some kind of investment or bank statement showing it on a $250,000 house that they have $250,000 plus in some kind of investment. So they have the ability to pay cash for the property. but then behind the scenes, you can still get a mortgage.
Okay.
Yep.
Are you coming across a lot of reverse mortgages anymore?
No, no, not really.
Yeah.
When they first came out, they were very, very popular, and the fees were outrageous. And the lenders that did them, we didn't do them, and we still don't, but the lenders that did them made lots and lots of money. And they kind of came down on that and said, wait a second. Most of the money was being made by the lenders and the attorneys and all that for reverses, and now it's different.
I don't know what the circumstances behind the scenes were, but that we've had done 3 different transactions where it was reverse mortgage, and now they were short sales. So I'm not sure exactly what happened with it, but the people.
Because the interest keeps accruing.
Yeah, and all 3 had lived in the home. 2 were condos, 1 was a house. The owners of the reverse mortgage were in their 90s, so I don't know if they had lived past what they expected, or.
Right.
But
more
they
than
ended up being I think those were probably some of the first ones.
Had to be.
And
Because there's an age limit on when you have to take one out by. You know, they're not going to let you be 90 years old and take one out. Obviously.
yeah, these had been long existing, and
Yeah.
and most of the time the family had started. All 3 of them,
Yeah.
the family was involved and not the owner anymore.
Yeah.
But they ended up being short. I never had to know what the details were, but I just feel a little uncomfortable with them,
Yeah.
especially from some of the history I've heard of the original ones. I suppose some of the new ones you hear about probably the rules caught up with them,
Yeah.
and now they're probably a little bit better.
What about assumable mortgages?
Assumable mortgages are mortgages like FHA mortgages that we talked about earlier, government backed, they're assumable. But typically nobody assumes them. 99% of the time they're not assumed.
Okay.
The reason being is that, the first 7 years of a mortgage, 30-year fixed, is primarily the interest. And after 7 years, you start getting into paying back more principal. So if someone's been in a house 5 or 6 or 7 years, and then they go to sell the house and it's an FHA and they advertise it's assumable, they first have to qualify. They have to pay a fee to assume the loan and take over the interest rate. Number one, the interest rate has to be far greater than what you can get today, which isn't the case. But secondly, most of the interest on the loan is up front, has been eaten already, taken away. So that a tax break is not as great. So virtually almost never does a loan become assumable. Now, granted, if we did an FHA loan today for 3.75 or whatever the interest rate is, and interest rates 4 or 5 years ago from now go to 6.5%, it might be a pretty attractive loan. But I don't see that happening. It could happen in the future, but it's not really happening right now.
Okay.
Back to the baby boomers, I was going to ask you with them when they're buying their house, you were saying that giving it, moving to, I think I already asked you the question
What?
about the Florida. Moving to Florida, you can handle those transactions. So, Maria, do you have a question?
When we spoke before the show, you said something that was kind of interesting that I don't think we had really thought of, that you had a younger buyer and that buyer doesn't have a checking account.
Yes.
So I assume you're coming across this on a regular basis now.
Well, more than once, but
Yeah.
so the first time it happened, as you know, when you write up a real estate contract, you have an initial deposit with the offer, say $1,000 with a check, and so you present your offer and whatnot. And I had a buyer say to me, we were talking and they were asking about, well, how much money with the initial offer? I said, well, talk to your agent, but, and whatnot. Then you'll have to give a second deposit of, a certain percent or dollar amount. And, well, how do I do that? And I said, well, you include a check with your offer. And, what do you mean a check? So I was actually schooled that day, which was interesting after 30 years in the business, that there was no checking account, that some buyers now don't use checking accounts at all. And everything is just, Venmo, or it's just transferred and, electronically. So that's kind of an interesting thing. Mm-hmm. Yeah. Have you come across that?
Well, we just recently had a client who, she does not have a checking account, so she had to wire transfer the money.
There you
It was
go.
in a rental. Is that's other?
Yes.
And they were making it sound like it was going to take some time to do,
Yeah.
which had made us a little uncomfortable, but we actually ended up having enough time
Right.
to deal with it. I have another client who's now living in the Aleutian Islands,
Okay.
and she's renting her place down there, and we have to figure out how she's going to get paid. I'm sure Venmos and stuff like that will be able to be done.
Right.
But she does have a local checking account, but honestly, she's living in Dutch Harbor,
Yeah.
Alaska. And we were just talking today about getting the first deposit on a rental. And I was starting to be puzzled by how we were going to get we were going to have to mail her the check, I assume,
Right.
or figure out a wire transfer.
Right. Yeah.
Back to younger buyers.
Sure.
If a younger buyer has a condominium, and then they're thinking, okay, now I want a house, but they
very
decide
common, yeah.
they want to use the condo
Right.
as an investment property.
That was my question.
Yeah.
What do you think of that?
Yes, we see that quite often. So the first thing is, for qualifying for a mortgage for a house, the question really comes down to is do they qualify carrying the condo payment, so condo fee, mortgage payment, the new payment on the new house? Do they qualify from an income standpoint to carry both of them? And if they do, terrific, you're all set to go. If they don't, if they need rental income to offset part of the condominium mortgage and condo fee payment, then basically they've got to rent it prior to closing on the purchase of a new home. And the way we do that is a copy of a lease, a copy of the security deposit and first month's rent, and proof that it's been deposited into their bank account. And then we typically take 75% of that amount. So if they rent their condo for $1,000 a month, we use $750 to offset what their condo fee payments are, mortgage payment, and then they only have to qualify for the difference.
Okay.
So if their condo fee, mortgage payment, everything is $1,000, and they're getting $1,000, we'll use $750. They only have to carry $250. That's all. The other piece of it is that when you are purchasing a property and carrying another property at the same time, you can't cut it so close that you're using every penny to close. You have to have what they call a cushion, and a cushion is a few months of reserves of your mortgage payment on the condo and a mortgage payment on the house. And the reserves could be 2-3 months, it could be 6 months, it really depends on the loan you're taking. The good news is, for the cushion, for the reserves that we're not touching but showing, it can be retirement accounts. And we'll use 60% of that. So if somebody says, well, I've got $50,000 in an IRA or a 401k with my employer, we'll take 60%. So we'll take 30,000 of that, and that will count toward the cushion.
Okay.
And what kind of special programs are there for certain occupations, like, for example, police officers, things like that?
Yeah, there are some programs, through especially the state of Connecticut, for certain fields. So people in certain fields, like police officers and nurses and things like that are typically a slightly better, lower interest rate, and possibly a smaller down payment as well. First-time buyer programs, normal first-time buyer programs around here typically have income caps on them. The income cap recently on one I just did was about $96,000 a year. So sometimes I will get a client coming in saying, I make $125,000 a year, do I qualify? And for that particular program, the answer is no. They make too much money to qualify to receive a beneficial rate on that.
I had one where the husband was a police officer and his wife was a full-time college student. So
Right.
so then they only had one income at the time. So
Right.
And
Right.
they bought one. Another question has come up is two-family homes. If someone plans to live in one floor and do the second one.
Easier to qualify for in terms of income because you can use the rental on the other unit towards qualifying. But two-family homes have a little higher taxes than typically a single family. But it's still easier for a two-family because you've got that rental piece that you can use.
And is there, since you're going to be living in it, is financing easier, or do you need bigger deposit?
Well, you need a bigger deposit for a 3 and a 4 family.
Okay.
But a single family or a two family is still a relatively low down payment and
Okay.
relatively easy. Yep.
Back to what you were talking about just a few moments ago about income caps. Say you know you're going to get a promotion at some point in the future. Is there any kind of conversation you should have with like your manager or anything to hold that off if you're planning on buying something and there's income?
I think you have to look at what your closing date is when we verify your salary and your income, and make sure that you don't make over the income cap when you close.
Yeah.
If your salary increase happens to hit after you close, there's nothing you really can do about it.
Yeah. Okay. All right.
How about new construction home? If somebody wanted to build a house,
Sure.
Is there some more steps in that one?
Well, there's two terms, and they're actually different loans, but they sound the same. There's a construction loan, and there's new construction, and it sounds like the same thing. New construction is when you're purchasing a home from a builder who may or may not have a lot or a house or a subdivision. You takes a down payment, builds the home, and 4 to 6 months later, you buy the home when they're finished. That's new construction. Just about every mortgage program's open to you, 5% down, maybe even 3% down on something like that. Obviously, holding the interest rate for 4 to 6 months is a little bit more challenging because you typically won't do that. You'll typically lock in within 2 months from the time you close.
Okay.
A construction loan is a completely different animal. That requires typically 20% down, and it's land plus home costs. So if the land's $100,000, the house is $300,000, your total is $400,000. And then you've got to put 20% down, that's $80,000. Then you would take out the construction loan yourself as the buyer, as the borrower, and you would pay the builder as he or she builds the house.
Okay.
On a builder schedule. It's a more expensive way to go. The interest rates are higher on those because there's just inherently more risk because if something was to go wrong during the construction of the house.
Okay.
What are you seeing for new construction loans, like at this time? Are you seeing a lot of them, or?
Some, usually the former though. It's typically the builder's got
Yeah.
a subdivision.
Okay.
It could be 5 houses, could be 30 houses, subdivision, and basically people are just going to purchase them when they're done at the end.
So one question also is that we've built a bunch of apartments here in Simsbury. Have you found that some people who have moved into the apartments have now decided to settle here? Have you noticed that?
Yeah, I have. One of the complexes in town is called Dorset Crossing, and done
They've been around for a little bit.
a little
so-
bit, a few
Yep,
years,
that's
3
right.
years or
Right.
4 years. And yeah, I've noticed a lot of clients coming out of Dorset Crossing looking, because usually that's kind of it's been like a way station. In other words, somebody moves to Connecticut, they're not sure where they want to be, exactly what town or what neighborhood, so they move there, whether it's 6 months or a year, to get a feel for the area and feel where they want to be, and then they decide.
Okay.
Especially younger couples moving out of Dorset to buy homes.
Okay, good. That's
I've seen that.
That's a real positive for Simsbury for sure.
Yeah.
Well, we really enjoyed having you on the show.
Well, thank you.
And you're so nice to talk to, and I hope people will use you.
Well, thanks very much.
And so we'd like to have you back to talk specifically about credit in the future.
Happy to, sure. That would be great.
Thanks again.
Thank you.
And we'd like to thank all our viewers for tuning in today, and we'll see you next time.
Funding for Simsbury Community Television is provided in part by contributions from viewers like you. Thank you.